If you're like me, you've been paying close attention to the pace and the path of interest rates. And like me, you've probably held your breath a few times throughout 2023. Then, after an October peak, yields have mostly declined. So, what's the story and what does it mean for your investments? We're going to break it all down for you right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Glad to be with you today. Leslie Falconio is my guest and back to talk about what's going on with 10-year treasuries. There's been so much movement lately, Leslie, and over the, since October, really when we hit that 5% peak, rates have been just declining so much and so significantly. So what's the story here?
Well, as you mentioned, the volatility in fixed income, particularly when it comes to interest rates, has been incredibly high. When we think about what's the gap in 2023, we were at a low of 3.25 and a high of 501. And even though we ended the year at a 388, which is essentially where we started, that gap is incredibly wide. And that volatility was very high. Now, as we sort of turned the corner into 2024, and as we saw really in the last 2 months of the year, November and December, the market started to gain a little bit of comfort, and that July rate hike that the Fed had accomplished was going to be the last one of the cycle. And finally, you started to see that trend that we have seen over the past 40 years when the Fed is actually done with the hiking cycle and goes from pause to pivot, is that the market has a tendency to decline in interest rates, anticipating the next move, which would be an ease. Now, when you think about what's been happening in terms of inflation trending lower, seeing a bit more balance in terms of the labor market, given the fact that things like, the quit rate is declining and, although the labor market remains strong, it's definitely, starting to see a little bit of cracks within the system. Now, one of the things that we're going to look at throughout 2024 is really about what the market is pricing in and what we're expecting. And what I mean by that is we had a really sharp decline in interest rates to the end of the year, and we moved up very quickly as well. So the first 4 or 5 days of the year, you've reversed a little bit of that sort of overzealous rally. Now, in the longer term, our expectation is that interest rates will trend lower through the second half of the year. But in the short term, we might see a little bit of angst because of this sort of push me, pull me of what the market's pricing in versus what the Fed communication is actually going to be. So therefore, we wouldn't be surprised to see interest rates rise a little bit in the near term.
Yeah, and it's interesting because when you look at that 10-year chart, it almost looks like Mount Everest. You've got these really strong peaks higher and then these declines lower. And the volatility, as you mentioned, is something that fixed income doesn't usually see. Have we seen markets like this before, Leslie? What's happened there?
Well, listen, I think that we've seen markets like this before, but normally it's you have some sort of fat tail event that causes this kind of, this dislocation. But you have to remember, too, a lot of the volatility that we're seeing is because how low interest rates got during that sort of post-pandemic paradigm. You had interest rates fall to 50 basis points in 10-year yields, right? So when you're at that low level of a base, volatility is going to be very high until you start to normalize. And now we think at these levels, around the same 4%-ish that we're at right now, we have normalized. So when you're at the higher rate level, the volatility should start to be a little bit less, but unfortunately, it probably won't be until the second half. And I think, Anthony, we saw this actually on Friday. If you saw what happened with, the strength of the labor market or the headline strength of the labor market between what happened with ISM, you had a lot of move. And I think you're going to see that in the short term, but for the longer term, vol should trend lower.
Yeah, the labor number that you're talking about, non-farm payrolls for December came in at a rise of 216,000 jobs, and the expectation was only 162. And above the previous month of 173. So jobs are still strong, and we still stayed at 3.7% unemployment. So it kind of, well, we're going to get into the Fed in a moment and what their expectations are. But kind of taking it back a step, when you look at fixed income risk assets, especially in November and December, right there in the last 2 months of 23, they did pretty well. So does the expectation of where rates might be going dampen any of your outlook for this year?
Well, I think going forward, and to your point, Anthony, and you're absolutely right. I mean, when we think about how much spreads compressed into the last 2 months of the year, and over the year for that matter, I mean, it was fairly large, particularly in what we call lower sort of credit quality type sectors. So when we think about what the performance driver is going to be in 2024, it's not going to be from spread compression, right? It's going to be either from carry, your yield, and number two, it's going to be duration. right? It's going to be the interest rate risk that you take on as yields fall. And in that second, so that the latter part of that, that's where we feel that investors can be very sort of tactical and opportunistic. And as I stated before, I mean, interest rates could rise, in the short term, maybe to 4.25, but you should be adding to at your interest rate risk at those levels. But because spreads had gotten really, really tight the last 2 months of the year as financial conditions loosened, there's nothing that's really this, screamingly cheap. There are cheaper sectors than others. I mean, agency MBS we feel is much better of a relative value play than investment grade corporates, even though the corporate sector as a whole we continue to like. The spreads have gotten very tight there, but we like the carry and we like the safety. But it's really going to be going forward. It's going to be about the yield that you're earning and your interest rate component that's going to drive your total return, not spread compression.
Right. So, Leslie, let's get into the Fed here for a moment, because something interesting, the Federal Reserve Bank of New York recently did a consumer survey, and they asked consumers, what do you expect inflation will do? And they're actually looking at numbers where consumers expect inflation will decline pretty significantly throughout this year, somewhere around 3% versus 3.4% when they did the survey in November. And they're basing that on what they're seeing at the grocery stores for food prices, even in some places, rent prices. I don't think that counts here in New York, but in other places, rents may be declining. So when the Fed takes those kinds of things into account, and then they look at the jobs numbers, and they're looking at yields on treasuries, what are your expectations for what they will do this year? Has it changed your outlook from what we were talking about in late 2023?
Well, when you think about it, the aggressiveness of the rate hikes that we've seen throughout the past couple of years has been due to inflation, right? That's been inflation driven. When we think about the other side in terms of rate cuts, I mean, obviously it'll be partly inflation going down, but also you're going to have that growth and employment component, sort of that dual mandate, if you will. And we do expect inflation to continue to decline. Whether or not they get at the 2% is another story. And by the way, you're going to have fits and starts. I mean, housing is a perfect example. We're seeing sort of this uptick in sort of housing prices, and this could escalate as interest rates move lower. But the Fed is going to look at both components. Now, I think that they, more than likely, they've solved for that, supply congestion that they saw in terms of inflation, and now they're going to keep an eye on that. But now they also have to take a look at growth. And growth right now has been, it's been strong. It's lower, right? But it's definitely still, the Atlanta GDP now is running, say, 2.3%. So they actually now look at both being just, okay, I have to hike because inflation's high. It's going to become a little bit more balanced. I think the difference is that the market has a tendency, particularly the fixed income market, is forward looking, right? So it has a tendency, and we've seen this playbook before. They really get very aggressive in terms of the amount of easing that they price in, even before the Fed does it, and B, really even before the Fed dictated from a forward guidance perspective that they were going to be as aggressive. So I think that's part of the volatility that I'm talking about in the first part of the year, that you're going to have these fits and starts of, cuts, correction, until more data comes in and we get into the latter part of the year.
Right, exactly. There's a lot that we have to look forward to and a lot of tea leaves to read. So as we're wrapping up, Leslie, we're just almost out of time, but for investors out there, given where we see rates going and everything we talked about, what's your outlook for 2024?
Look, I think fixed income is going to be a strong total return, right? But it's really important to understand what those drivers of total return are going to be. And like as I said, I mean, what we call excess returns are those returns that result in things like the yield that you're earning and spread compressing because financial conditions are looser, the equity market's doing well, high demand. Those kinds of sort of drives of total return in the excess return component may not be as strong as we saw in 23 because we're starting the year at fairly tight spreads. What that means is as you get corrections, which you will, right? And given the fact we have a soft landing, you be opportunistic and you add on, right? And the second thing is that we still think that carry is going to be a really big driver of total return. And that carry, and number one, and two, the interest rate component where you're going to have price appreciation, will also be a driver in 24. And we think they're going to be at least, mid single digits. But again, you can be opportunistic about it. Spreads will widen after tightening up some in the past 2 months. That's not a catalyst. You should view that as an opportunity.
Terrific. Leslie, thank you so much. It's great to hear that there are still lots of opportunities for investors out there. Good to be with you. Thanks, Leslie. See you soon.
Thanks very much.
Absolutely. Get you back in no time. And for our viewers out there, a couple things you can do here as a follow-up. Check out our website, ubs.com UBS.com/views. Follow UBS on social media, and you can also follow our studio on Instagram at UBS Trending. And don't forget to continue the conversation with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everyone, and remember to keep your eyes on what's trending. See you soon.